Western perspective, let's say the institutional perspective on emerging markets. I'm going to talk about pension funds and other investors like life insurance companies, and they have to invest money for their clients, and they can invest it in emerging markets. And the question is, do they do that, and why do they do that, and how do they do that? Now, do they do that? Yes, they do. But why? What's the rationale to do this? Well, first, there's higher expected economic growth. That is, well, maybe it's a good idea to first reflect a bit yourself on why you think there will be more economic growth in emerging markets. So maybe it's time to stop the video now. But, well, one reason is that there are really let's say, unused growth opportunities still. For example, emerging markets can rapidly copy the technology of the West and make everybody more productive. And, for example, in emerging markets, people are still not so much urbanized. They still live in the country and not so much in cities. And in cities, people are more productive. If people move to the cities, they get more productive. So there are all kinds of reasons why there's more growth in emerging markets. These are just a couple, but and that will also reflect in the returns to stocks and bonds. Then there's a demographic dividend. So demographically, many emerging markets are still very young. So that means that let's say the financial burden of a social system is not that high yet, and it means that production is more cheap. It's not always true. There are some emerging markets, for example, China, that has very bad or worse demographics than others. Maybe it's also a good idea for you to think about some countries that have good demographics, young demographics, and some other countries that don't. So that's one reason. Labor is much cheaper, and that means that it's, from a capital perspective, good to invest there because you can make that capital more productive. There could be better access to resources. That also, of course, doesn't hold for all emerging markets, but it does hold for some. And then, of course, it depends on the resources. And that access to resources may be a blessing. Sometimes it's a curse. And there are countries like, for example, the Congo, where access to resources is basically destroying the country and has been destroying the country already for a century. So that's not always a good thing. But sometimes it helps in economic growth. There's an upcoming middle class in many emerging markets. Tanja already showed the example of Taiwan and South Korea, who are a big part of the MSCI Emerging Market Index. By many definitions, they are no longer emerging markets, but developed markets. But in 1950 or something, North Korea and South Korea were just as poor, dirt poor. And Taiwan was also really, really, really poor. Hunger poor, so really, really problematic. And right now there's a middle class that is almost as big as the middle class in Europe. And that means more consumption, and that means also opportunities for Western investors. Then there's diversification opportunities. You can spread your risk. There's a scarcity of financial assets, so that means that if you introduce financial assets there, then they may do well financially, and maybe there's also an ESG reason to invest in emerging markets, just to make this world a better world. So apart from any return perspective, maybe you should go into emerging markets because it's just the good thing to do. Now, maybe it's also a good idea for you to think of other reasons to do this, because this list is not at all complete, but I leave that to you. So now, if you want exposure to emerging markets, how do Western investors do that? Well, and they do it. So generally, Western investors, like, for example, the pension fund that Tanja and I are insured with for our pension is called ABP. It's the pension fund for civil servants in the Netherlands. And that pension fund has been investing in emerging markets already for a long time. Structurally, they don't go in and out, they go in and they stay in. And so that's really a structural thing. And it's, I think for most pension funds and other institutional investors, that's the case. Once they go in strategically, they stay in for the long term. But then the question is, how much do they need to, what percentage of their portfolio do they need to allocate to an emerging market? Does it need to be 5%, 10%, 20%, 30%, everything? Well, it's not so clear. So now there's a certain theory, it's called the capital asset pricing model. That's a very important financial theory that is actually, you could say, the workhorse of finance, and in block 1.5 and also in other bachelor courses, this theory has been important. And one of the basic insights of that model is that only market risk is priced. So, you could say that every asset has two sources of risk. It has the total risk of an asset you can distinguish in the market risk, so the risk that the whole market has, and the risk that is specific for that particular asset. So one market risk source could be, for example, the interest rate. If the interest rate goes up, the value of all assets goes down. That's just a present value thinking. If you don't understand it, think about it a bit, reflect on that. But that's happening. So that's a risk that holds for everybody, for every asset in sort of more or less the same way. So that's a market risk source. But there are also specific risks. So for example, if the oil price goes down, then probably the returns to oil company go down. But that's specific to oil companies and not to other companies. Other companies may actually profit from lower oil prices. So only market risk is priced. That's one key insight. And the other key insight is that the best diversified portfolio, so the most efficient portfolio, is the market portfolio. That's basically the composition of the global stock market. And that has implications for the allocation to emerging markets, because then that means that if emerging markets are important in the MSCI stock market index, which is the leading international index, and Tanja showed that they are increasingly so in her introduction, that means that that alone is a reason to invest in emerging markets, and that if you use the market as guidance, you use the composition of that index to determine how much, what percentage of your capital to put in emerging markets. Now this graph is from MSCI, and this graph shows you the emerging equity market capitalization as the percentage of the global capitalization. It ends in 2015. I was trying to find a more recent graph, couldn't find it. But you see here that emerging markets are about 10 to 12% of the global market capitalization. And that would mean, if you believe in the CAPM, if you believe that you should, that your portfolio should reflect the composition of the global capital market, that's indeed the most efficient portfolio, then that means that you have to put 10-12% of your money in emerging markets. Now, do pension funds do that globally? No, they don't. They invest less in it. This graph shows you how that works. You see that it's a bit of a strange graph, but the wider horizontal line in this graph shows you the average of pension funds allocation. So that's about 4% in 2010, has increased to about 5% in 2017. Then one standard deviation plus and minus, that's sort of the square around it, and then the max and the min, that's the the upper and the lower line, the upper and lower horizontal line. So some pension funds really put a lot of money in it, up to 15%. Some almost nothing, 1% or something, but the average 4 to 5%. So you see that on average, these institutional investors put less in emerging markets than what they should do, just basis on their country weights. So I think maybe this is a time for you to reflect a bit on why that would be the case. So maybe it's a good idea for you to stop the video now and think a bit about that. Why would pension funds on average invest less in these emerging markets? Okay, well, a couple of reasons could be, for example, that they deem them too risky. But there's also something else going on that's called a home bias. And that means that in general, investors invest more in their own home country or their own home region than far away. And emerging markets aren't part of their home region. So with home bias, there will be less investment in emerging markets, and that's exactly what you see. Now, another reason could be that a large part of the emerging market capital markets is actually not available for institutional investors, because the free floating capital is not there. So if you look at, for example, GDP weights, well, then you would, by 2012, already invest 30% of your money into emerging markets. Well, but not all companies who produce that GDP are part of the stock market index. So that also already reduces the exposure. And then there's also the lack of free float. So in emerging markets, a lot of the companies that are listed on the stock market are either still largely family owned, so that a large part of the stocks is owned by a family, the founding family, and is not listed on the stock exchange. So it does count in the capital, in the capitalization of the market, but it can't be accessed by outside investors like Dutch pension funds. And there are a lot of state-owned companies that are also listed, but where a majority of a minority of the shares are in the hands of the state, and again cannot be accessed by institutional investors, and therefore institutional investors will necessarily, even if they would want, to invest in emerging markets, they have to then lower their exposure. Another reason could be that the institutions of emerging markets are much weaker. So what we see is that if you just look at the risk and return of emerging markets, and then you judge risk in terms of beta or standard deviation, then they look really attractive. But maybe it's true that beta and standard deviation are not sort of telling you a complete picture in terms of the true riskiness, the true total riskiness of emerging markets. And this table suggests that that's indeed the case, because what you see there is you could say, the institutions that are important for investors in emerging markets versus developed markets. So the upper part of the table is developed market, the lower part of the table is emerging markets, and the word high means good, so that means that this particular institution is well developed, and the word low is bad, because it means that this particular institution is weakly developed. And you see the word high all over the place in developed markets, so in terms of contract enforcement, the rule of law, regulatory quality, voice and accountability, enforcement of property rights, political stability, and the control of corruption. It's all pretty good hunky-dory in emerging markets, in developed markets. But if you go to emerging markets, not so great. So there are some highs. So in the Czech Republic, for example, you see a lot of good stuff, but there's also a lot of lows and a lot of medium. So a lot of these institutions that an investor wants to know about and wants to be certain about that everything is fine are not so well developed in emerging markets. And that means that there's more risk than maybe the standard deviation of the stock return will suggest. And that could be another reason to say, maybe I'm going to put less of my money in emerging markets than I otherwise would. Now, that's also reflected in this graph. Here you see that these are three graphs. One is the MSCI World, and the upper gray one is the MSCI Emerging Markets. So MSCI World is all the countries in the world, so that's United States, European countries, Korea, etc., etc. And then the gray one, the line above, is just the emerging markets. And what you see there, well, maybe this is again a good time to reflect a bit before you go on about what you see there. So what you see there is, of course, a lot of volatility. And the emerging market graph goes up and down much more strongly than the graph of the world as a whole, which also includes the developed markets. But overall, in the long run, since September 2003, you see that the return has been higher. Not by much, but it has been higher. What you should also see from this graph is that the period that you enter the market is really important. So if you would have entered in September 2003 and just held on to the shares, yes, indeed, you would have had more volatility and also more return, so fine. And so in the end, the return counts. But if you would have entered this market, let's say in 2011 or 2010, there you see that actually at that moment, emerging markets were priced much more expensively than the world as a whole. But since then, emerging markets have not really gone up much. So if you would have gone in 2011, so about, well, 9, 10 years ago, then in fact, developed markets would have done better than emerging markets. So this is the long run graph, but even in pretty long sub-periods, emerging markets have been outperformed by developed markets. So this is also something to realize. Over the long run, yes, they outperform, but the long run can take a pretty long time. And another important thing is what investors are doing in a crisis. So I told you that most investors who are active in emerging markets are active for the long run, are active structurally. And so they go in, they track an index, and they keep their money in. But this graph shows you that this is not always the case. This is a sort of an event study. It looks at 4 crises, the global financial crisis, the temper tantrum, the China scare, and the COVID-19 crisis, so the most recent one. And it looks at accumulated non-residential capital flows to emerging markets. So basically, it looks at what people who are not based in that emerging markets, what investors not based in that emerging markets, do they put their money in and put their money out? So it's the total net effect. And it looks, and T is the moment that the crisis starts, and then T plus 15 is 15 working days after the crisis, T plus 30 is 30 working days, etc., etc. So we're now at T plus 90 or something, or T plus 100, I don't know, but this is very recent. So there you see, and this is all in billions of dollars. So you see that institutional investors in the COVID crisis have withdrawn about 100 billion US dollars from emerging markets, which is a lot of money, and that's far more money than they did in the previous 3 crises, where you also saw withdrawal of capital, but the withdrawal has been much more sharp right now. It has also happened in a relatively short time period, basically a period between T plus 30 and T plus 60, a 30-day period, and it has been stabilizing. The last month, nothing much has happened, and the capital right now, there's no net capital outflow anymore. So probably capital will also flow back in. But from an emerging market perspective, this is pretty annoying, because exactly now that you need the capital to do something about maintain your economic growth or something else, there's no capital from foreign investors because they withdraw it. Not all of them, but for 100 billion they do. Interestingly, if you do look at the performance of the stock markets in emerging markets in the last month and a half, 2 months, it hasn't actually been so bad. So 100 billion looks like a lot of money, but in fact, if you look at it currently, if you compare it to the current value of the emerging markets stock market, it's not even such a big amount anymore. So this used to be really big relative to emerging markets economies, but now, they have been growing so much that even 100 billion not so scary anymore. So then the question is it justified that investors pull back their money? And the question is really no, because if you look at the long-term performance of emerging markets and you adjust it for risk, then yes, they have more risk, but they also have more return. And the risk seems, yes, there's more volatility, but if you look at the downside risk, it is actually not that big in emerging markets. The volatility is more actually on the upside than on the downside. So again, volatility may not be standard deviation, because that's a measure of volatility, may not really be the right way to look at this risk. And the MSCI emerging market index has a beta of 1.17, but more importantly, an alpha of 4.87 on an annual basis, and it is very strong. So that measures the outperformance of the stock. Another reason I talked about why you should invest in emerging markets is diversification, but as this graph shows, that's not really a good argument anymore. You could say that this has been a self-destroying phenomenon, where in the beginning you see really low correlations, a correlation being the statistical tool to measure how things move together. And the correlation here is basically the movement of developed market stock markets and emerging market stock markets. If that correlation is very high, they move up in tandem. If it's really low or negative, they move. If it's negative, they move against each other. And if it's around zero, then there's really no relationship. And a low correlation or even a negative correlation is a sign of very good diversification potential, because then if one market goes up, the other doesn't move or even goes down, and then you can be more certain of the return you're going to get. So that's a very big diversification sign. And you see that the correlation used to be low, around 0.4, 0.5, and that means that diversification effects are really there. But then gradually it moved up. The correlation is now 0.9. Now, if you know that correlation is a statistical number that can move between -1 and +1, so +1 is the absolute maximum that a correlation can be, and you see that the correlation is already 0.9, then you see that almost all diversification benefits have disappeared due to the very capital flows that are now far more in line with each other and that make capital markets move in line with each other. So the capital flows that have been begun as a result of the diversification potential have also reduced that diversification potential. So that's no longer a reason to go to emerging markets. So let me talk about the key takeaways to part one. So just emerging market size justifies the structural allocation by institutional investors, because that's the capital asset pricing model. If it's there, then it should be invested in, part of the market. As a market, they're not yet fully integrated in the world capital market. They're still treated as separate asset classes. Their institutions aren't so strong yet, so it could be that the traditional sources of risk, let's say the traditional measures of risk that we use are to judge markets don't really apply so much. And they're still underrepresented in institutional investor portfolios. Like I said, the part of the international capital markets that they reflect is about 10 to 12%, but on average institutional investors put about 4 to 5% of their money into it, so there's an underrepresentation there. Now I have 4 questions for you to think about to digest this lecture and to really put your thoughts on for a couple of minutes, I want to say, but even more, maybe better for a couple of hours. So maybe it's good for you to reflect on the reasons why institutional investors find emerging markets attractive. I already gave you quite a list. So think about that critically. So are these really strong arguments to go into emerging markets? What are the limitations of these arguments? And can you think about other arguments to go into emerging markets if you would be an investor? So take the role of an investor, the thinking of an investor. The second thing I want you to reflect on is the question whether institutional investors' capital allocation, and so the percentage of the capital that they put into emerging markets, should that be growing to the capital market rates? The capital market rates are like 12%. Should your pension fund, my pension fund, invest 12% of their assets into emerging markets? Think about that. And 3, don't you think that, again, Tanya and I, our pensions are insured with ABP, and when we're 65 years old, for Tanya that's still 40 years away. For me that's about 10 years away. Then I really want to count on that pension, and I want to be sure that that pension is right there. And don't you think that maybe institutional investors should then avoid emerging markets because they're a bit too risky? Think about that, because a pension is really something that you want to count on when you retire, and if you invest in emerging markets, you can really count on that pension. And 4th, there is the global COVID crisis. You see that some investors have taken out their money, not so much pension funds, but other investors have, by about 100 billion. Do you think that institutional investors should do the same? Or do you think that maybe they're already too late? that they should just stay in and just go with the flow. Think about that.
The Netherlands or like in this area?
That's correct.
Yes, thank you. Thank you very much. So I went to school.
No, you were so wrong.